Today, I wanted to talk finally about simulating stock prices. We've had a number of pieces sort of talking about risk, sort of leading up to this, and I'm happy to go into a couple more pieces in the future about other ways to simulate stock price movements. But this is a very effective tool in quantitative finance. You can use it for risk management, but also looking at profit potentials of different investments, different portfolios, different strategies over time. So today, I mostly wanted to build a little bit of intuition around what it means to simulate a stock price movement and sort of where those models really come from, or at least the commonly used ones come from. Make sense?
Yes, makes sense. Perfect.
Okay, so just to kind of recap a little bit, so far we have covered several different historical risk metrics and forward-looking option-specific risk metrics. So we've talked about implied volatility, we talked about the Greeks, we've talked about buying power, and today we're also going to focus on forward-looking risk measures, but specifically from simulated stock price movements. And today I really wanted to focus on building a bit of intuition on how that actual simulation process is done. Again, cool tool in quantitative finance, and hopefully give a little bit more context to some of the behind the scenes of what quant people do. Make sense?
Yes.
Very nice. Okay, so just to recap, so this is sort of like the outline of many of the topics that we've been talking about in this series where we're sort of talking about measuring risk. And today, again, I wanted to focus on forward-looking metrics and specifically distribution statistics from simulated data, or specifically talking about like how the simulations are even done in the first place and where those sort of models come from. Yeah?
Okay. Yep. Cool.
Amazing. It's about to get heavy, just as a heads up, but hopefully by the end, it's going to make a little bit more sense as to what's actually going on. And we're going to start with a pretty big phrase called geometric Brownian motion. I've talked about it many times, but today I wanted to talk a little bit more about what it actually means and what implications it actually has when it comes to specifically simulating stock prices. So the Black-Scholes model is really where this assumption comes from. The Black-Scholes model was really like the first formalism to give the theoretical fair price of an option ever. And that was from the 1970s. And it really allowed options trading to be practical because now you had an actual framework for pricing an option. Whereas before that didn't actually exist. There was no objective framework for pricing an option. And this is where I think a lot of the simulations around stock price movements are really rooted in, was this formalism. So the Black-Scholes model asserts that stock prices follow a geometric Brownian motion. We're going to talk about that, what that means, but specifically with constant drift and volatility. And within the context of stock prices, constant drift is the constant expected return of the stock. We assume that the expected return of a stock is constant, and the volatility or the variability of returns we are also going to assume is constant. So basically this assumes, or this asserts, that stock prices are continuous. They have normally distributed log returns, and they have constant drift and volatility. And so here in this little graphic, this is an example of a particle. This is actually derived from fluid dynamics, which is super cool. It's used in chemistry, it's used in physics, but this is a particle undergoing Brownian motion, which is a type of motion that, sort of meets the criteria that I described. And when you look at the displacement on one axis of the particle over time, you actually see something that looks pretty close to a stock price, which is kind of cool. Which is part of why this model was actually used to describe stock prices. So even though this model is used to describe fluids, it's used to describe concepts in physics and chemistry, we can also use it to approximately or mathematically describe stock price dynamics. And here we see an example of like maybe why that association was formulated in the first place. Do we get?
Yep.
So, but these are very core assumptions that we're making around stock prices. And so we're assuming, right, continuous process, normally distributed log returns, constant drift and volatility, and they have dynamics that can be described by the following stochastic differential equation. Stochastic differential equation, I would not worry so much about the terminology. I wanted to include the SCE here for completeness, and I'll briefly describe what that is. But basically, this is a mathematical representation of stock price movements. And we're basically saying that a tiny change in the stock price over a small time interval is equal to the expected rate of returns times the price at time t, multiplied by that small time interval, this tiny little wiggle basically, plus the standard deviation returns at the times the price at time t, and then times this change in Brownian motion over a small time interval as well. There's a ton of quant finance textbooks that describe where this equation comes from, why it's formulated specifically in this way. We're mostly going to talk about the applications and the implications of this formula. But if you want to learn a little bit more about where it came from, there are a bunch of different quant finance books that'll actually do that, or even like Wikipedia. But this stochastic differential equation is really what we're going to use as the basis sort of for our stock price simulations. And I'll talk about what that means in a second. Yes?
Yes.
Okay, so this is a specific type of differential equation. And what we can do is create an approximate solution for this equation. So basically, through some mathematical mechanisms that I don't want to get into, like that's way too into the weeds. But basically, there's a solution that approximately solves this equation, which is given by this. So this is specifically called the discrete time approximation. There are analytic solutions for this, but I wanted to talk about the approximation because I think it's a little bit more intuitive. But basically, this solution to this equation, which is asserted by the Black-Scholes model to be true description of a stock price movement, this solution is basically what we can use as a model for stock price dynamics, driven by some standard normal random variable ZT. And what we can conclude from this approximation is that each step of our stock price, for each time step, our stock price is going to move a little bit. And what drives that dynamics, there's two different components. A deterministic component, so a component that we can predict, which is going to be based on these parameters that we're using to describe the stock price. So this is going to, I'll explain what these mean in a minute. But what we want to know is that stock price movements are driven by two different factors, basically. One deterministic component that's based on the fundamental factors of the stock price, and one that is a stochastic component, or a component that's driven by randomness. So these two components put together are really what's going to make our stock price move over or evolve in time in a particular way. Does that make sense?
Yes. So will you say that possibly fundamental stuff be applied for the deterministic component, or not really?
I think that, well, I'll talk about the sort of limitations, because when it comes to the deterministic component, we also have to make certain assumptions around the stock price dynamics that are not necessarily true. And I'll talk about what that means in a minute. But if we're assuming that there is some kind of deterministic component, that would sort of imply that there's some sort of, reliability, I guess, in the long-term performance of certain stock prices, which is not necessarily a true assumption, but it would certainly be asserted by this model. Does that make sense?
Okay, yes.
So for example, positive drift is something that we observe in the markets. The markets are not much more likely, but slightly more likely to go up compared to going down, right? So this is something that we can sort of reliably assume over time. Well, that assumption might not necessarily be true, but it's something that we have enough historical data to sort of make that assumption. And so when we say, for example, that the stock market returns on average 9-10% per year, that might not be true on any given year, but in the long term, we might expect that to be true. So that's sort of like what this deterministic component, that there's sort of similarities there, if that makes sense.
Yeah. So maybe for the September, for this month, that tends to be the worst month, could be possibly one factor.
It could potentially, yeah. But here we're just sort of looking at a simpler model for price dynamics. And I just want to make it, sort of explain these two big components and how they sort of drive price evolution. And that's like very loosely where they come from. They come from this stochastic differential equation, which is asserted by the Black-Scholes model, which is formulated on the assumption that prices follow a geometric Brownian motion. So very high level overview, highly recommend looking at quant textbooks if you want to like learn a little bit more about exactly where these came from. But in order to understand how the simulation is actually done, it's really just this approximation or this conclusion that we can use as a basis for that in actual applications. Make sense?
Yeah.
Okay, so geometric Brownian motion. So here we have this standard normal random variable ZT. It's basically a random variable described by a normal distribution with mean 0 and variance 1. So this stochastic component, or rather the component that drives the stock price trajectory over time, that has this element of randomness, is going to be randomly sampled from this distribution for each time step t. I'll talk numerically what that means in a second. I'll give a little bit of a translation, but that's what the ZT term is. For each time step, there's a little bit of randomness that's randomly sampled from this random normal distribution, standard normal distribution. And that's in our model of stock price dynamics derived from the Black-Scholes model, where this element of randomness is introduced. And that's kind of what that is. I'll explain more in a minute, but does that kind of make sense so far?
Yes. It's making sense.
Okay, here's basically a translation of everything that I just said. So basically, according to this specific model, for each time step, so for each day, for example, that the stock price evolves in time in our simulation, in our model, the price of the stock is equal to the equal to the price of the stock at the previous step, evolved by two different factors. There is a deterministic component over the time increment. So there's some deterministic component that's set basically by the parameters of the stock price, which is the expected return minus this correction term that comes from the volatility. And then the other component that's going to kind of move this stock price over time is a stochastic component. When we say stochastic, what that basically means is that it's some kind of process that's driven by a random variable. And what that random variable is going to be is this time and volatility scaled random normal variable ZT, which is basically just this random variable that results in some random sampling from a standard normal distribution, which is just a normal distribution with mean 0 and variance 1. So I wanted to give sort of a numerical example to hopefully contextualize this equation a little bit. So, okay, let's look at an example. So first, consider a stock that's trading at $100. It has an annualized expected return of 5% and an annualized volatility of 20%. This is not out of the realm of possibility. We could, plug these numbers in, take a look at any different, you could look at Amazon, you could look at SPY, and you basically say, what's the current stock price? What is the annualized expected return? So how much can we expect to gain over 1 year? And what is the annualized volatility of returns? What is the standard deviation of that measurement, basically, or the uncertainty of that measurement? So this is our stock price, right? Our stock with our different variables. So in our equation, our S naught is going to be 100. So the first step where it's starting out basically is going to be $100. Our mu, that expected return, that drift term, is going to be 0.05, and our sigma is going to be 20. So we're taking these different calculations and we're plugging them into this equation, which looks at the stock price evolution over different time increments. Make sense?
Yes.
So now we're going to assume, suppose we want to simulate daily stock price movements over 1 year. So for each time step delta t, that increases in increments of 1 over 252 because we're looking at a 252-day time horizon and we're looking in increments of 1 day. So for each delta t, that's going to be 1 over 252, right?
Yep.
Man. So we're going to take these parameters. So these are, approximations that we're making about the stock price. And specifically this mu and the sigma are going to go into the deterministic component. So we're going to make these approximations based on maybe historical returns, for example, and say this is how much we can reliably expect the stock price to move with each time step. And then we can move into this sort of stochastic component, or this sort of component that's driven by a little bit of randomness. So we're going to say both of these factors are going to cause our stock price to evolve in time a little bit differently.
Yeah. So you wouldn't put here nothing on for the stochastic component for the random part?
Here, I just want to talk about the deterministic components and where those come from, right? So you can look at SPY, for example, look at the expected returns that like 9-10%, per year. You can look at the average volatility of returns annualized, and you just take those variables and you plug them in. And specifically, we're looking at S naught, or the ST term for time value 0, which is going to be that $100 where it's starting out. Make sense? Yeah.
Yes.
So here we're just looking at the deterministic components. And then we can look at the stochastic components. Okay, so we take those different variables, we plug them in, and then for each time step, we're going to take some random sampling from that standard normal distribution. So for step 1, for example, so our stock price, remember, it's starting at $100, and we want to say, like, in this simulation, where will it move next? Remember, we have those deterministic components, and now we're going to look at the stochastic components. Yeah. So we're going to randomly sample from that standard normal distribution ZT for time step 1. So let's suppose that we get 1.998. That's just a random value that we take from the standard normal distribution. It's got mean 0 and variance 1. So it's going to be a normally distributed curve with these possible values, right, that are determined by the mean and the variance. So let's say on the first time step, we randomly sample the distribution. This is where that element of randomness comes in, right? And we get 1.988. This gives us a stock price. So our first evolution, it's going to go to $102.55. We go to the second time step. We do the same thing again. We do another random sample, but this time we get 0.609. We now have moved from 102.55 to 103.35. We're evolving it in time, and that randomness is coming from our random sampling of this distribution variable. On the third time step, we take a third random sampling, we get 1.181. Now we evolve from $103.35 to $104.91. We go to the fourth step, we do it again. Each random component, right, this randomness that's getting introduced in our stock price movements comes from that sampling of that random variable distribution, which comes from ZT. And each step, we're going to take another random sample. We're going to take our deterministic component. We're going to take our stochastic component. And we're going to look at the evolution of the stock price according to this model. Make sense? Kind of?
Yeah, kind of. What will determine the number of steps you take here to decide? Like,
you can determine how many you want. Maybe you want to look 1 year in the future. That's 252 trading days. Maybe you want to look 10 years in the future. Maybe you want to look 1 week in the future. You decide how many time steps you want to look at, because you're basically determining how much in the future you want to simulate. You can look at, right. So for example, this is 1 year. So we're looking at 252 trading days. We're repeating this process 252 times. And this is one possible price trajectory according to this model. And thus we've completed our first simulation. Let's suppose that we repeat this process 100 times or 1,000 times or however many times. This is how you do a Monte Carlo. So if you repeat this process, so remember that we looked a year in the future, right? And that gave us this one simulation where each time step we looked at this model and we calculated the different terms for each step. And that gave us a 1 year sort of time horizon simulation of the stock price movements. If we now repeat the simulation 100 times, we can now do an analysis on the distribution of possible outcomes. So we can look at, POP, CVAR, other historical risk metrics. You can check out, the previous segment to see exactly how that's done or what you kind of look at. But this gives us a variety of different outcomes so that you can analyze the most and the least likely outcomes. And so, for example, if you wanted to look at the possible P&Ls of an option, you can plug an option into here. Maybe you want to sell the 120 put 150 days out or something like that. You can plug that option in and then look at the possible outcomes of the stock to determine things like POP, to determine things like CVAR. It's all sort of rooted in this simulation method. And then when you repeat it many, many, many times, you can sort of look at, from a risk perspective, what the different likely outcomes are. Does that kind of make sense?
Yes, I did not know that this is where the Monte Carlo simulation came from. The overall metrics used, especially for the deterministic component, I feel like that's a more simple way to understand. But yeah, that's clear and better to understand.
Cool. This is, I will admit, like the derivation is tricky. Those metrics are relatively easy to understand, but it gets more complicated when you, for example, look at a portfolio. So now you have a bunch of different assets with a bunch of different volatilities and expected returns. What are the possible trajectories of that, that portfolio? What can happen? Or when you look at options, for example, when you deal with options, now you obviously have the Greeks, but this can be a very helpful tool sort of for more complex instruments, for more complex strategies, for more complex portfolios. And it's really like, it's kind of a plug and play. You just need some element of randomness, and then you're able to sort of infer these different risk measures, which is kind of cool. But I wanted to talk a little bit about the limitations of using this. And the primary limitations with the simulation method really come down to how the price dynamics are actually simulated, right? So recall when we used this model, which is a very common model for stock price dynamics, we assumed that stock prices are continuous, they have normally distributed log returns, and they have constant drift and volatility. And we know that's like not true, right? We know that stock prices are not continuous, they have earnings, so you get like jumps, right? We know that they really don't usually have normally distributed log returns. We definitely see deviations from that all the time. We know they don't usually have constant drift and volatility. So like year by year, those are dynamic variables. And this sort of neglects those different factors. But there's other types of models that you can use to model stock price dynamics that sort of capture more of those subtleties. For example, the Heston model accounts for variable volatility that specifically looks at the evolution of volatility. You can look at the jump diffusion model, which sort of takes jumps from binary events like earnings into account to get a different model for what the possible dynamics might be. But hopefully this left a little bit of a better intuition, I guess, around what exactly is going on behind the scenes when we do some of these simulations.
Monte Carlo simulation. Is there other places you might actually take this random information besides the normal?
Yeah, there are different distributions that you can use, but this is specifically like a derivation from the Black-Scholes model, right? Because we are assuming that this is the description of a stock price. This is, again, asserted by the Black-Scholes model, and we know there's limitations that come with this. There's different formulations that you can use for this equation, and thus different outputs for this model that you will receive or get. So the Heston model, for example, is a variation of the Black-Scholes model that takes dynamic volatility into account and then creates a volatility model and treating it as a dynamic quantity. So the actual form that this is going to take is really going to depend on sort of like what formalism you're using, and you want to make sure there's mathematical consistency when sampling from different distributions, not the standard normal distribution one necessarily. It's just important that there's consistency throughout the model in terms of which one you'll actually use. So one of the reasons why I wanted to do this whole thing is because I wanted to talk about GARCH models, which are generalized autoregressive conditional heteroscedastic models, volatility models, which kind of take that autocorrelation into account, which is kind of what you're talking about, where you have like big moves that are sort of clustered together. They kind of might come one after another, or when you might see more correlation in the signal itself. And so GARCH models kind of take a little bit more of that phenomena into account. And they also sort of like fit into this formalism a little bit. But I kind of wanted to start with the foundation, which is like, okay, stock simulations, where did they come from in the first place? And this is really, I think, like the foundation for that, if that makes sense. I mean, like this stuff, for example, like I know there's services that offer like stock price simulations, but I think there's something kind of cool about being able to do it yourself. Because like this, I used a Python code, a very simple one, admittedly, but like a Python code to be able to do that. And understanding like this implementation, like, I mean, theoretically, anybody could do this, right? Anyone has access to Python. Anyone can take this, plug it in, and then do their own simulations. And I think there's something really cool about the, I don't know, open sourcedness of it all. So that's kind of why I like to talk about it. But I know that we've gone a bit over, so I just wanted to jump right into the conclusions. But so to conclude, using models such as geometric Brownian motion, stock prices can be simulated and analyzed to determine likely risk factors according to that model. But all stock price models come with limitations, such as the ones that we discussed here today. So in the upcoming segments, we're going to dive a little bit more into the different models that can be used to simulate stock and volatility signals and how that's kind of done. But hopefully you guys found that interesting. I know it got heavy, so thank you guys for sticking through to the end. I hope you liked it, or I hope it made the art of the simulation make a little bit more sense, because I think it's cool as fuck.
Julia made it super cool, definitely. I really liked it, and honestly, one of my favorite topics so far.
There's so much more to do. This is just the beginning, bro. Today, I hope we learned something about stock price simulations. You're going to sound really cool at parties now. But yes. Let me look at the comments. I was kind of focused on my segment. Is this page 25 in the book?